Thank you, Madam Deputy President. I rise to speak on the Treasury Laws Amendment, making sure multinationals pay their fair share of tax in Australia and other measures bill. Madam Deputy President, if the projections in the explanatory memorandum are correct, this bill will allow Australia to secure an additional $255 million in taxes over the forward estimates, which is positive, but merely a drop in the ocean in the bigger picture. Tax avoidance is a major issue costing consolidated revenue billions of dollars each year, and that's billions of dollars that can't be spent on doing good across society. This bill is heading in the right direction, but more can and needs to be done. The effectiveness of mechanisms and activities of foreign-owned multinationals to reduce their tax payments in Australia is quite staggering, and if you were to believe some of their financials, you would be convinced that they are in fact non-profit organisations that continue to operate here purely because they enjoy the business. And we know that's not correct. Drawing on numbers from the tax transparency data that is now provided by the Tax Office for the periods of 2013 through to 2016-17, I'll elaborate on the magnitude of the problem. So, Madam Deputy President, let me just talk to you about 5 companies on that list. ExxonMobil, income over 4 years, $33 billion. How much tax do you reckon they paid? 0. Not 1 cent of tax paid on $33 billion of revenue. Energy Australia, $30 billion. 0 tax paid. Virgin Australia, $17.9 billion, 0 tax paid. Vodafone, $15.1 billion, 0 tax paid. Santos, $14.9 billion, 0 tax paid. A total income of more than $111 billion and not 1 cent of tax paid over the 4 years that money was generated. The name Energy Australia sort of conjures up the belief that this is a grassroots Australian company, but it's actually owned by a company in the British Virgin Islands, a well-known tax haven. Last year, Energy Australia reported an income of $6.3 billion, but unfortunately their costs were such that in the end there was no taxable income. Of course, this could have just been a bad year. Surely it's an anomaly. However, it's not. In fact, over the past 4 years, Energy Australia has not paid any tax, despite the company having a total income over the period of $30 billion and a reported taxable income of $52 million. Now, Madam Deputy President, I get that companies have bad years, but when you've got 4 years in a row where a company is making billions and billions of dollars and not paying a cent of tax, something is wrong. Defence companies are an area where the government, particularly through the Department of Defence as a customer, has the substantial ability to exert influence. They can establish the contracts, they have direct access in many cases to the financial records of these companies through their projects, and the ultimate choice in utilising the suppliers that do the right thing. Yet the top 5 defence companies in terms of income are maybe not as bad as the top 5 companies overall. However, from tax records we can draw out that they've had a total of roughly $14.5 billion and paying only $287 million in tax. Not even 2% of income. To make matters worse, in reviewing AusTender records, you can find cases where the Department of Defence is signing contracts directly with companies registered in tax havens. The Department of Defence has a contract with a value of almost $500 million with Intelsat LLC of 90 Pitt Bay Road, Pembroke, Hamilton, Bermuda. On one hand, we're trying to clean up tax avoidance and ensure multinationals are paying their fair share of tax, and in the other, we have the government department signing contracts with companies in tax havens. This is not a situation where the company's got some elaborate corporate structure and is using creative loans and licensing vehicles to avoid or at least minimise their tax. These are companies where the government's simply trucking the money or shipping the money to the tax haven. It makes no sense. You can't be serious about tax avoidance if you're allowing those sorts of things to happen. So, despite Australia having been one of the first countries to implement the OECD's country-by-country reporting, establishing the Common Reporting Standard, which came into effect in July 2017, that was going to, and I quote, combat tax evasion by exposing taxpayers with hidden offshore investments, it appears we're making little tangible progress. Despite the introduction of tax transparency laws, tax evasion remains a significant issue that we are yet to address. Look, it's entirely appropriate for companies to make a profit. That's a reasonable thing for them to do, but it's also very reasonable for those companies, when they do make a profit, to pay tax when they're conducting business in this country. So when foreign companies come here and they set up daughter companies, they enjoy the benefits of our social system. They enjoy the education that brings them competent and well-educated workers. They enjoy the fact that when their workers are sick they can go to a hospital. They enjoy the infrastructure, the roads that lead up to their workshops, the traffic lights, all of the things that make our society function. They enjoy the fact that our defence forces are making us safe at home and that our intelligence services are keeping a watch on events. All of that costs money. You can't simply come to this country and operate a business and get all those things for free, and that's a significant problem that we have. I've looked at the tax transparency data that is provided by the Tax Office, and when you look at that, you look at all of the people that are paying tax. I can tell you there's not many multinationals in there. They seem to be very aggressive in their tax practices. Now, going back to this bill, the three schedules of this bill are the tightening of thin capitalisation rules for multinational entities, the requiring of offshore online hotel booking providers to include hotel room bookings in calculating their business turnover for the purposes of GST, and removing the luxury car tax on re-imported cars sent overseas for refurbishment. The thin capitalisation has the greatest impact, however, with an estimated $240 million over the forward estimates, but it's not groundbreaking. It's quite insignificant in the big scheme of things. If we consider the top 5 companies and assume that their profit was just 1%, the same as the current cash rate, there would be an additional $330 million in tax collected. At 3%, approximately $1 billion. And that's just the 5 top companies. So Centre Alliance will support this bill, but we need to be doing a lot more. We need to be dealing with these companies that come to Australia, enjoy all of our benefits and pay no tax. And I'm happy to inform the Senate that it's going to be a task that I'm taking on in this parliament. I'm going to be calling out the names of every company that is operating in this country that is not paying tax at some stage. I'll be questioning ministers why we're dealing with some of these companies at question time. I'll be questioning secretaries at estimates to try and understand why they are engaging with companies who pay no tax. And I think that's a reasonable question to ask, and I'm going to be very, very receiving of any answers that come from ministers and secretaries when I ask those questions, because it's not fair on Australian taxpayers. I think it was Senator Brockman who made the point that for every company that's not paying tax but enjoying a benefit, the burden shifts to other players. So this is an important bill. We will support it, but a lot more needs to be done. Thank you.
Thank you.